Good evening, everyone. Hopefully you can hear and see me. For those of you that don't know me, my name is Nick Shawanambas and I'm the Managing Director of Alpha Wealth. I'm joined by two of my colleagues this evening. You can hopefully see on the screen, Cliona O'Donoghue, who will introduce herself in a moment, and also Keenan Cunningham, who's our Head of Marketing. Cliona, do you want to give us a quick...
Yeah, hi everybody and good evening. My name is Cliona O'Donoghue, as Nick has mentioned, and I am the Director of Business Development with Alpha Wealth. So welcome everybody this evening and thanks for joining.
So just to mention, this is the last of the personal evening presentations that we're doing this year, specifically focusing on trying to get tax back before the year end for high rate taxpayers. So Cliona and myself are going to spend the next 25 minutes or so just going through a few, I suppose, opportunities really for you and explaining to you specifically how we feel you've got up to the next 4 weeks to effectively avail of tax that you've already paid this year. Just before we do that, you can hopefully see a poll that my colleague Keenan has just kindly put up. And really, we just wanted to get a sense of, I suppose, how much of an opportunity this is for people. So basically, the scheme that I'm going to go through there shortly is predicated by how much money you earn. The more income you earn, the more tax you pay, the more of an opportunity that you will have. So again, we're not looking to try and pry into people's personal affairs. It's just to try and get a sense of exactly kind of where people will see how much they can actually save. So if you wouldn't mind answering the question, and we want to try and keep this as informal as possible, guys. So if you can put into the Q&A function any questions, Cliona's going to be sort of posing questions throughout the 25 minutes and also give an opportunity at the end. You can ask them anonymously even, or indeed just with your name. But thank you very much again for joining this evening. And as I said, please do feel free to ask any questions at all in the Q&A function. Just before we kick off, for those of you that are not familiar with Alpha Wealth, and I appreciate there is quite a few people that have listened to some of the webinars, we are a Cork-centric company with 8 fully qualified employees. We have a nationwide reach now, doing Zooms with people, Teams meetings, and also in person. And we are providing full independent advice to individuals of all types. So I suppose in terms of today, Cliona, do you want to just give a quick sense of...
Yeah, I suppose it's just, Nick, just to tell us a little bit about the EIIS scheme, if you don't mind, and just what you're going to cover this evening.
So basically, I've thrown up sort of 4 questions, the first of which is explaining specifically this opportunity of a scheme that some of you may not be familiar with, called the Employment Investment Incentive Scheme, or EIIS, and explain how it works. I'm also going to show you how you can get back 4,000 euros for every 10,000 euros that you contribute or invest. I'm going to give you 3 companies that we have selected as a company that are the best in class and why you should consider them as an opportunity for you to get this tax back. And lastly, and I suppose I've answered this question already, what is the process? The process is that if anyone is interested in availing of any of the opportunities that I mentioned this evening, and we feel very strongly that these are the only ones you should look at this year, that it takes about 5 minutes for us to send you some documentation and for you to sign up and get involved in this and get your tax back. So the EIIS scheme, basically how it works, the scheme was started in 2011. Its predecessor was called the Business Expansion Scheme, or BES. It was a more restrictive scheme. It was higher risk. It wasn't something that I would have suggested to people. Thankfully, the government introduced EIIS and they've made it a lot more attractive over the last couple of years. Pascal Donoghue said in the previous budget that it was going to last for a further 2 years. So you've got this year and possibly 2 more to avail of this opportunity. And the real, I suppose, thing to understand is that you can qualify as a high rate taxpayer by making a contribution into one of the 70 or so companies that are looking for finance that are rubber stamped by the Irish government. And we feel very strongly that it's a great opportunity for people, particularly if you're earning either rental income, POA income, you're a director owner, or indeed even pension income. So it's really available for all types of individuals. The one caveat is that you must be earning income at the high rate of tax.
Now, Nick, can I just stop you there because a question has come in? So what, if any, of the opportunities mentioned don't apply if you're on a stamp one visa for over 1 year, but less than 5 years? And I think that kind of comes into, if this person is paying tax in Ireland, do they qualify?
Yeah, so basically the scheme is available to anyone who is tax resident in the Irish Republic. It doesn't matter where you're geographically based. So the fact that the person who asked the question, and thank you for the question, if you are paying tax in Ireland at the higher rate, you can qualify for the scheme. So it doesn't matter how long or how short that period happens to be.
And can you give us an example of how the EIIS scheme works, if you don't mind?
So very simply, guys, and look, this is a very simple kind of illustration, but it works very well. If you have an opportunity to invest money that you have in a bank, post office, credit union account, you may have the ability to access money through some form of liquid investment, or indeed shares that you may have through your company, or indeed hold it personally. The major opportunity for you is that, let's say you earn 50,000 euros a year as an income, so hence being a high rate taxpayer, you have an opportunity where you can invest that 10,000 euros for a minimum period of 4 years, where you will get back 4,000 euros from the Irish government on that contribution early in 2023. So typically within the next 8 weeks, you could be getting 4,000 euros back into your bank account. The benefit of the scheme is that for the period of 4 years, you have no access or control to that money, but you expect to get that 10,000 euros back with interest in the region of about 20%. Now, I classify this as a double your money scheme. You can look at this as saying you've put in 10,000 and you've got back 16, 4,000 from the government and 2,000 from the company that you lent the money to. Personally, the way I look at this is to say that your net investment is 6,000, 10 minus 4, and then you get back 12,000. That's 100% return. And that's why this scheme is so attractive. And bearing in mind, 4,000 of that, or 40% of your investment, is tax-free. It's a rebate of tax that you've paid this year.
And just before you move on, Nick, can I just ask you another question, I suppose, about what is the difference between the EIIS and, let's say, investing your money in a pension?
People sometimes think that this is a replacement of a pension scheme. I see it as a complement. The challenge for all of us is that whilst many of you would have a pension, and I would actively encourage you to consider putting money into your pension scheme, that you're limited by the level of contribution. If you're a POE worker, for example, if you're in your 30s, you can only put 20% of your earnings. In your 40s, it's 25%. And depending on how much you earn, you may be limited by what you can put in. The benefit of EIS is that there are advantages and disadvantages. The advantage is that it's all income, so it includes rental income, for example, and also the fact that the tax relief is given to you early, but also that the scheme only lasts for 4 to 5 years, whereas a pension scheme obviously could be, depending on your age, anything from 5, 10, 15, 20 years plus. The other thing, however, is that EIS is very specific. It's based on a company or a limited number of companies that you invest with, which a pension scheme obviously can be much more broader. So what I say to people is know about both opportunities and consider your own position. And it might be a case of balancing between the two. I'm just going to talk now about some, I suppose, specifically 3 companies that we have vetted and we would recommend as an independent broker. We have no bias to these companies. And specifically, they are Blacks of Kinsale, who are a Cork-based whiskey alcohol distributor, BVP, which is a renewable energy fund, and Halo Care, who are a medtech company. You can see there that they have slight variations. For example, the minimum contribution levels. Some companies have slightly different entry points. The industries that they are involved with, the term of the investment can vary slightly, and also the return that you can make. The cap, which it mentions there on the screen, is basically the limit to how much you can make. So for example, Blacks of Kinsale, you can earn on 10,000 euros a maximum of 2,008 euros interest. On Halo Care, it's 25%, which is 2,500. Whereas with BVP, it's uncapped, but because of the variety of companies, it realistically would be limited to in the region of 25 to 30%, depending on the, I suppose, the performance of each of those companies that are involved. Again, tonight is not to try and give you full information, guys. It's to try and give you some basic knowledge about the scheme, how it works, the companies that we'd recommend, and we're asking you to consider further and explore the opportunity if you're in a position you know you can, and obviously you'd like to speak to us and get specific advice.
So before you move on to the next company, Nick, can I just ask you another question? So through this scheme, are people buying company certificates, or is it literally a cash investment?
It's a good question again. So there are slightly different variations of this as well. Some companies offer shares, they're ordinary shares in the company, but they're capped in the case of, say, Halo Care, for example. Some other schemes offer you an alternative form of share where they convert in the event of, say, a default. So there is no, I suppose, hard and fast answer to the question, but essentially there are legal agreements, because if you said, Nick, well, okay, what if I did invest in the Blacks of Kinsale, and if the owners just decided to not pay me back, or they were acting disingenuously, what rights do I have having made the investment? Well, investing through a qualified advisor like Alpha Wealth, I would suggest, would put you in good stead, obviously through the vetting process that we do, making sure that you understand, I suppose, the basis of the investment and the legal agreements, but also more importantly is that what would happen in the event of, you know, obviously a default or a company that doesn't act genuinely. And there are very stringent conditions on these companies, which part of which are through revenue, obviously, that mind them, but also through the fact that you need to be comfortable with the company that you invest with. Interestingly, the Sunday Business Post did a supplement on the 20th of November, showcasing a variety of different companies, some of which respectfully I wouldn't touch with a barge pole. You know, these were people's ideas that I'd be very concerned with, whereas we would like to think that through our experience and independence, that we're coming to you with what we believe are best in class, as I said earlier.
Sorry, now before you move on, there's a second part to that question, and you kind of addressed it, but I think just in the interest of asking this question, just so you can address the second part. So it just says no or limited risk of losing the investment after the required period. So I think you just need to address the whole situation around the risk involved, or if any, with EIIS.
Yeah, so I was going to come to that, but I may as well address it now. So for anyone who's invested, let's say, 10,000 euros this year into one of the qualifying companies, what are you guaranteed? Well, you're guaranteed as long as you make sure you do it through a trusted provider. And I can assure you that Alpha Wealth would never put a client into a company where we believe there was any fear of you getting the tax relief. So you can tick the box and say, okay, well, Nick's saying that with his 25 years of experience and his professional wherewithal, that I'm going to get my 4,000 back in 2023. The investment that you make, the 10,000 euros, is that guaranteed? Absolutely not. I think most of you would understand that anybody that sits here and tells you that you're going to earn 40% back from revenue and that you're going to have an investment lasting for 4 years, that you're guaranteed your capital, it doesn't work that way. We know that the risk-free rate of money at the moment is close to zero. So what is the risk? The risk is that the company that you placed your money with, whether it's Blacks, Halo Care, or whether it's in a fund like BVP, are not in a position to pay you back after 4 to 5 years. Why would they not pay you back? Well, it's because they're not financially trading well. So you need comfort and confidence in the fact that these companies will do that. And I'm going to go through that briefly. So yes, it is possible that you can lose 60% of your investment. But I'd look at it another way and say to you, if you are in a position where you are paying tax at the higher rate and you do have money that's sitting in the account doing very little for you or is invested in something that isn't tax efficient, you can use that money, get your 40% relief, and be comfortable in the fact that you've invested money through a qualified advisor where you've looked at the information that's been presented to you, you've asked all the relevant questions. We give amples of information, we give access to the owners if people want them to ask as many questions as they want and get comfort around these. But these companies have done very well over the last period. They've typically grown during COVID. And as I say, we've had a lot of experience in investing clients' monies over the course of time. BVP have been investing clients' funds for many years now. They're on their 15th fundraise, believe it or not, over the course of the last number of years. Blacks of Kinsale, very profitable company. And again, I'm going to go through that over the next couple of minutes, just to give you a sense of the opportunity.
I'm sorry to interrupt you again, Nick, but I think these questions are relevant while you're on this slide. Is that okay if I just
Absolutely,
ask?
yeah, please do.
Okay, so is that example there showing Blacks B ordinary shares or preference A shares?
Both, really. With Blacks, there's an option of the two types that I described earlier, which is basically you can buy into the investment with what's called ordinary shares, where you're not in the capped scenario. I've actually surmised this and given you the capped return, which is the preference A shares, where you're limited. Now, you sit higher above the ordinary shareholders in Blacks' balance sheet, which is why we favor this one. My view on this, guys, is if you can get 28% from Blacks, regardless of how well they perform above that, and you get your 40% relief, that's a fantastic return on investment. Again, I'm back to doubling your money over 4.5 years. Yes, the question is relevant. There is an option with Blacks to take what's called the ordinary shares where you're not capped. And that's something that you can decide as an investor. But for most people, I'd encourage you to look at the preference A shares because, as I said, they are more secure than the ordinary ones. Sorry, Clea, do you want to continue?
No, I said thanks. You're good to move on.
Okay. There is one other question there about, is there a full list of companies that are eligible? There isn't really. This is a kind of a case of you go out and seek. Unfortunately, Revenue do not provide you an extensive list of companies because there are new companies coming to market almost every day over the next few weeks. The key thing is that you want to be assured of the fact that you are with the best companies. As I said, as an independent broker, we've narrowed those down. And I do feel very strongly that I have a lot of experience in this space. I can tell you a lot of stories about companies that we've invested with in the past that have done very well. And this is really about, as I say, giving you the best opportunities in this environment. I'm just going to talk briefly, guys, if you don't mind, about the three companies, just to give you kind of a flavor. So let's talk about Blacks of Kinsale first. I live in Cork, so I suppose I have a slight bias to a Cork-based company. But Blacks are a very profitable company. Their turnover this year is north of 3 million. They made profit last year of 625,000. I met with the business owner, Sam and Maudley Black, about 2 months ago, and I saw the site that they're developing currently. They're going to build a multi-distillery plant, the first of its type in Ireland, which is going to enable them to sell more of their spirits, primarily whiskey, globally. It's going to enable them to provide the product cheaper, obviously, because they're going to be able to distribute it and distill it themselves rather than using the likes of Great Northern Distillers and so on. They are a fabulous company. Honestly, for myself as in Alpha Wealth, where we set up at the same year that Blacks did, I can tell you that my balance sheet looks nothing like theirs. Now, they've won various awards. They really are an impressive duo. And what I've really liked about them is that this EIS has been overseen by Westborough, who are Cork-based accountancy firms. So they're overseeing the EIS approval. Been very impressed by how they've acted. They're very available. Sam Black is a very knowledgeable individual, as is Maudlene, but he's available to you if you want to talk to him. He invited me to go and visit the site in Kinsale with a client that was interested in making an investment. And again, if anyone is interested in doing that, you do have the opportunity to do so. But as I said, it's certainly, in my opinion, for an industry that's growing globally, really worth considering, as I said, and the entry level for that is €5,000. BVP is a very different proposition. So instead of one singular company, what BVP do, and they have a really good vetting process, is they cherry pick and select companies in the renewable energy space. So you're looking at wind, solar, renewables, and they essentially picked the best companies in that environment using some very stringent process and using their expertise. And typically with that, you get arguably a bit more security because you've got 8 or 9 companies versus the one, but you have a situation where it does take longer. So the downside of for BVP, I should say, is that your investment, rather than it being a 4.5 year term, you're looking closer at a sort of 5.5 to 6 years, because the time it takes them to deploy the money to the 8 or 9 companies and then disinvest at the end typically adds another year or so to your investment term. But for some people, they don't mind that, and therefore they may feel comfortable, particularly if you are blending your investment, guys. So if somebody does pay a lot of tax at the high rate and has cash in the bank, my suggestion to you is to consider more than one of these companies. And typically that's what we've done for clients throughout the years. The last one I just wanted to mention, and I won't go through this in too much detail with you, as I said, tonight it's just about a flavor of these, is Halo Care. This is a company that we've just added to the suite of products on our portfolio. And basically, Halo Care provide remote patient monitoring. We've been really impressed by the discussions that we've had with them. One of the key influences for us were the people that set up the business, David Walsh and Niall Kelly, who I'd be familiar with from NetWatch, and they were the former CEO and CTO of them. Many of you may be familiar with NetWatch. Incredibly impressive company, uber successful, and again has grown phenomenally globally. And basically they're bringing their expertise, and they've added a really good team to this market where I suppose I don't come from a medical background, but it makes sense to me in terms of, you know, allowing people, typically older people, to live in their own homes, and by using really fantastic, I suppose, patented technology where, you know, it provides a really great medical service through a medical device and so on. And you can see there on the screen the extent of the opportunity globally and how the business is looking to scale. And as I say, you know, it's giving you the diversification, because obviously these companies are very, very different in the markets that they are, I suppose, actively seeking. And really, as I say, it's giving you an opportunity to find out more. And that's really where we see our role in this. What Halo Care are looking to raise the money for is international expansion and growth, which is typically the same for all three of those opportunities we've mentioned this evening. And it's building out this predictive capability software called Aura, which from what I understood and heard during their own presentation, I have to say, sounds to me to be extremely impressive. You know, having had two elderly parents myself, who both passed in the last number of years, I can say it would have made a massive difference to their standard of lives in their later years had this sort of, I suppose, opportunity been available to them. So I suppose the final thing, just before we get on to the Q&A side, is that Alpha Wealth do more than just provide investment solutions. And for those of you that are not familiar with us, we do provide an independent financial advisory approach to managing people's finances, helping you find the money to invest in schemes like the EIIS scheme that I've spoken about this evening, helping you understand your pension, helping you to get to your endpoint and what I call financial independence through a variety of vehicles like EIS, like pensions, helping you make sure that you're not paying too much for your mortgage, any form of insurances, including health insurance, mortgage protection, and so on. We charge a cost normally of €199. We are discounting that to the end of the year to €99 if anyone wants to book in. If anyone would like to avail of the EIS opportunities that I've spoken about this evening, we will waive that fee. So again, you know, for anyone who would like to speak to us or indeed just get further information, we're more than happy to provide details of all the three companies that we've showcased this evening. I have to say, this is the best EIS opportunities that I've seen for many years, having been in this market. And it's really about making you aware of what the opportunity provides for you. So that's everything I wanted to sort of say. I would like to maybe bring feedback into this.
I'll ask a question, so Nick. It's regarding the fee. So if you could maybe go back to the slide where you have showcased the three different companies. Is the fee a one-off fee or is it an annual management fee?
So the fees that I've listed on the screen there, they are our minimum fees. We don't sort of overcharge our clients insofar as I put my best foot forward, and they are the lowest fees that we will charge clients for these schemes. So if anyone is interested in investing in Blacks, for example, they will pay a contribution towards it of say 5,000 or 10,000, and they pay Alpha Wealth 2% of their investment level. So for €5,000, that's obviously €100. That's a once-off all-in fee. Alpha Wealth charge that, and there's no further fees to incur. It's the same with BVP and the same with obviously Halo Care.
Can the EIIS scheme be done in joint names?
No, while some people are jointly assessed, it's an individual scheme. Now, obviously, if you're in a relationship, if you're married, or if you're in a couple, you can invest separately. And for people who have two higher income rate taxpayers in the household, if you can afford to do it, my suggestion is I would encourage you to do so. Some people often ask me, like, how much should you put into the scheme? And it really depends on how much tax you pay at the high rate which is why we asked the question on the poll. If somebody's earning 100,000 plus, you know, you may feel that you're in a fantastic position. Your biggest problem is the tax man. And this is one of very few opportunities, typically two, the only other opportunity for you is pensions, where you can reduce the tax that you pay. The reason why we've, I suppose, focused on EIIS at this time of the year is that really between now and Christmas, this is the only game in town. This is the only way you can get tax back for this year, by making a contribution into one of the qualifying companies.
So I suppose the qualifications for this is that you have to be a high rate tax payer. And does it only include your employment income?
No, so as I said earlier, the great benefit of EIIS is that we have many clients who earn a lot of rental income, but have very little POI income. And this scheme is fantastic for them because they can't put much money into a pension scheme, but they can invest heavily into the EIIS. So anyone who is in receipt of rental income, my suggestion to them is that because you're paying tax on the rents that you earn, you should consider trying to rebate some of that money that you earn into EIIS and getting some money back from the tax man. So it's all forms of income that EIS qualifies for.
So is the potential 4K rebate only from the higher rate tax I pay, or?
Yes, it is. So again, the simple example I gave earlier is that if you're earning 50,000 euros, you will absolutely be paying tax at the high rate of 10,000 euros of that money. And therefore, by making a contribution to EIIS, you will get back 4,000 euros from the tax man.
So if you are related to the owner of a company, is there an alternative option to invest in the company and save tax?
It's a good question, but Revenue have basically blocked individuals from investing in what they perceive to be a connected party. So business owners themselves cannot invest in an EIIS, and typically connected parties cannot. Look, I have seen, relatives, and it depends on, I suppose, how direct a relationship you have with the business owner, invest in EIIS schemes. Typically, Revenue frown upon that, but again, it depends on the extent of the relationship. Obviously, if you're married to the business owner, typically I'd say not. If you're a nephew or niece, I wouldn't see any issue as to why you wouldn't support, that business. And essentially, you have no real, I suppose, divine ability to influence the company. And that's really what Revenue are trying to, I suppose, avoid. But as I said, you can, and nothing stops you obviously investing in alternative companies in this model.
So I suppose that brings me on to the next question, where you talk about the alternative companies. Would you prefer or recommend investing in a single company or an EIIS fund?
There's no right or wrong answer, and a lot of it is subjective, and the reason why we give a selection is to give people the option. So it's not right for me to ram down one company to people. I want to be able to explain to them the pros and cons and the benefits versus the disadvantages. So I hope I've given a kind of a steer this evening around the three companies. I hope you can see the benefits, why we feel that they're market leading, and obviously allow you then to the opportunity. Now, obviously, if somebody doesn't have the capacity to invest 25,000 in EIIS, that obviously restricts their ability to invest in Halo Care. If, again, it's a minimum of 5K, it really restricts you then in terms of only blacks. But for those of you that have the ability to invest in all three companies, it's then a choice and say, well, okay, find out a bit more, look at the prospectuses, we'll provide you the detail, ask as many questions as you want, and make an informed decision. Some of these companies do close earlier than the year end. So some of you may be thinking, okay, I'll come back to you on the 31st of December. Unfortunately, it doesn't quite work that way. We are closed for business for EIIS typically from around the 15th of the month. So you've got about 2 weeks to make a contribution. Now, obviously, if that doesn't suit people who are listening to this call, my advice would be try and line yourselves up for next year. And the way you do that is obviously get yourself ready, educate yourself, look into these schemes, and know then when next year comes, typically around September, October time, that you've even built up the money to invest in the scheme.
And would there be a recommended amount that you would invest in EIIS? I suppose, given, if you're trying to balance out risk and you're looking at your salary, I mean, how can you Is there any kind of calculation maybe or anything that you can give?
The way I review this, and it's maybe a sort of simplistic approach, is that, again, it depends on how much tax you pay and how much money you have. There's two qualifications for this scheme, okay? Because the scheme is fantastic. You know, for you to make 40% tax-free from the government over 4 years is phenomenal. I can't emphasize how much of a fantastic opportunity this is. You know, you compare this to stock markets, which are struggling at the moment. You compare this to deposit accounts that are not paying interest. You really need to explore this. In terms of how much you do, it depends. So for someone who's earning 100,000 a year plus, you're paying typically 60,000 a year at 52%. The tax man is killing you. So if you've got money sitting in the bank that's idle, or if you're thinking about paying off your mortgage where you're paying interest of 2.5%, 3%, I'd say hold on, have a look at the companies, have a look at the schemes and see, are you comfortable with it? And it might be a case of just dipping your toe in the water this year. And then obviously next year, when you're more ready and you understand the scheme, you may go heavier. My only fear is that the government may put a stop to this, particularly if there is a change in government, and therefore you take the opportunity as you see it. We've provided you an opportunity for the next 2 to 3 weeks to avail of the scheme. And obviously we'd expect the scheme should be available next year with some of the same companies that I'm suggesting this year to you, but maybe some different ones. But it's really a case of where your situation lies. If you've received a gift of 50,000 euros from a relative recently and it's sitting in the bank, you really need to get on this and say to yourselves, okay, how can I get money from the tax man and benefit for myself in the future with a company that I can look at closely, know that Alpha Wealth is a recognized trusted provider, are going to recommend, and they're going to steer me and manage this for me for the next 4 to 5 years.
And if you invest in all three of the companies, do you get the €4,000 back for each one?
If you were to invest 10,000 into each, and if you paid 30,000 euros at the higher rate of tax, i.e. earned 70,000, absolutely. You know, why wouldn't you? Now, there is a limit to Halo Care. Obviously, if anyone is interested in Halo Care and they want to make a smaller contribution, we will speak to the company and we may get, you know, the say so. But obviously, based on the example given, of course you do. It's about the amount of tax that you're paying and your contribution level.
And you spoke about the rebates and the revenue, getting it next year. Can you give a timeline around when you would get the rebates and the revenue?
So I've been a little bit vague about that because it does vary. So for example, if you invest in a singular company, you would expect a rebate in the first quarter, certainly by no later than the first half of the year. However, the fund like BVP, because of the fact that they deploy the money to 9 companies, realistically, it's going to take the full year to get your money back, but it will be provided before the end of 2023. So the short answer to the question is next year. The long-winded version is it varies, but typically, again, it'll be somewhere between the first and fourth quarter.
And can you exit from these schemes early? And what is the longest period that they can run for?
It's a really good question. So you cannot exit early. Sometimes the companies may sell. So for example, BVP invests in 9 companies. One of them could obviously sell early. You know, you never know what opportunity there is. BVP have a great mechanism in place to safeguard people. So although the rebate for that company would have to be given back to revenue because it didn't satisfy the 4-year criteria, the fact of the matter is that you'd be compensated by BVP. Otherwise, they wouldn't allow it. In respect of the long term, the longest it can run for, it's indefinite. So obviously, if a company is struggling, but they are still solvent, they will ask you to wait because obviously they don't want you to lose your money. So you could find that there are situations, depending on the climate, that you could be in for 4 years, you could be in for 5, 6, 7, 8, 9+ years. I would expect, and obviously I would like to think that we put our reputation on the line here, that we would select the companies that we feel most comfortable with that will redeem you within the timeframes that I've specified on the screen.
And in terms of that rebate or, you know, the return and the profit, are you taxed on that return?
You are. Now, the tax that you pay on the profit from the company. So again, I'll use the example of 10,000. You invest 10, you get 4 back from revenue next year. You get your money back at the end of the 4 to 5 year period, as an example. And let's say it's 28% on blacks, that's 2,800. That profit is subject to capital gains tax. And the reason that's favourable is that you have an allowance of €1,270 a year that many of us don't use. So you can reduce the tax that you pay by that figure, and then you pay 33% on the balance. Of the example that I've given there, you'll end up probably paying tax of about 300 odd euro, which for the return of investment, again, is insignificant.
I think that's all the questions, unless anybody else wants to pop a question into the Q&A function before we finish up this evening.
I just want to thank you all for the questions, and obviously please do ask a question if you want to. Indeed, you can email me directly. My email address is very simple. It's just nick@alphawealth.ie. We have great people working in Alpha Wealth, and it's not just myself, guys. But what I wanted to say is thank you to everyone who has listened in to the webinars this year. Thank you to everyone who's listened in this evening, or indeed is listening to this recorded. This scheme applies for 2022, and you have until the 15th of December to avail of it. And even if it's a case of just exploring, there's no obligation to go into the schemes, of course, but it really is a fantastic opportunity. And as I said, tonight was really just about giving you some guidance, high-level information. But as I said, as an independent broker who I've been in the industry for 25 years, and I pride myself in the advice, any of you that have money that's not really working for you and have tax at the high rate, the two things go together like a hand and glove, and they work brilliantly. And I do think it's worth exploring.
1 second, Nick. A few more questions have come in, so if you don't mind answering just them before you finish up. So what if I put the return directly into my pension? Are you still caught for capital gains in that instance?
You are. Essentially, the money has to be paid back to you, and on the basis of that, it is a capital gain. Now, capital gains tax is a self-declaration tax, so you have to disclose that. We would encourage you to do so, obviously, but you can put the money then into your pension scheme, but you do face the tax bill at the end of that year for the benefit of the profit. Now, it's obviously only deemed at the end of the term of the investment. But again, the mentality of what you've said in the question makes sense. So what you do is you get the tax back from EIS, you invest in an EIS company, you wait the 4 to 5 years, you get the money back from the EIS company, and then you invest in your pension. So you're getting a double hit on the same money. And that to me sounds like a very good and credible opportunity for people.
In terms of the companies, are MX an option this year in terms of EIIS?
MX are raising money this year. It's not a company that we have on our suite of investments. We have used them in the past. We've, I suppose, looked to narrow down that opportunity to what we consider to be the best 3 companies that we're raising money for in this space. But the short answer to the question is yes, MX are raising money in this category. And if anyone is interested in more information on MX, we're happy to provide that. But for the purposes of this evening, obviously, we're trying to narrow down to the 3 companies that we feel are strongest going forward for the next 4 to 5 years. I just finish off, I suppose, on the poll.
There's 2 more questions.
Go ahead, sorry.
Are you okay to answer them?
Yes, go ahead, thank you.
Okay. Is it correct that in the example of putting in 10K with 4K back from the revenue, do you have to have paid the 4K in tax to revenue?
That is correct. But again, the example I'm giving, 50,000 of earnings, you're paying 52% on approximately 12,000 of that this year. You're paying 52% of 10,000 of that next year when the threshold rises. There's the $4,000 that you're claiming back, guys.
And this is around the share types A and B. So I assume both share types A and B ordinary are taxed in the same manner. Is that correct?
It is. There's absolutely no difference to the profit you make depending on the scheme that you go into. They're all taxed in the same manner. The tax, by the way, is very small. Again, just to emphasize, the benefit of the scheme is that it's a tax reduction scheme. Your 10,000 relates to 4,000 back. You make a profit, and it's only the tax on the profit less the annual allowance, the 1270, that you pay 33% on. The tax is the least of your concerns when it comes to this scheme, by the way. It's really about getting the tax back on your contribution that is the biggest winner in this event. And by the way, you're supporting Irish companies, and they are fantastic Irish companies, I should add, which obviously, given the environment and given the climate, these are companies that are performing extremely well.
One last question, Nick, and it's around kind of the €4,000 that you get back next year. So that immediate 4,000 that you get back the following year after your investment, are you taxed on that 4,000?
No, absolutely not. It'd be really disingenuous of me to say you're getting 4,000 back for the government to take it back from you again. The 4,000 is tax relief, guys. It's you basically sticking two fingers up to the tax man by making a contribution to a qualifying scheme. The tax man is rewarding you for helping an Irish company grow, and therefore they're giving you this tax incentive. You need to look at it like that. It's a very simple thing. You invest 10,000 in Blacks, BVP, Halo Care, you get your 4,000 back, and you've benefited from that scheme. That's it. The profit in the end, which I see as a cherry on the cake, yes, that is taxed less your allowance. But to me, getting your money back alone makes this a fantastic investment. Think about it logically. Over 4 years, you made 40%. That's a 10% per annum return, tax-free. It's better than any other scheme of any description. And therefore, that's the reason why I've been encouraging you to consider this tonight.
Now, there are I think people just looking for a bit of clarification. So if you invest 10K, for example, after the initial 4K back from the government, does the company pay back the 10K plus 28% at the end of the 4 to 5 years?
That's absolutely correct, yes. The company have your 10,000, and therefore they're going to pay you interest on the 10,000. The only reason why they go for the EIS scheme in the first place is they know that they're going to be much more likely to attract your money by you getting this tax rebate.
And is
they pay? Sorry, go ahead.
Sorry, is the 4,000 that you get back next year, if you invest this year, in a tax credit or cash rebate?
It can be both. Now, not to overcomplicate, but like I'm a PYE worker, I'm a company owner. I invest 10,000 in EIS this year, which I'm going to do. I'll get back my cert early next year, and I claim my relief and I get cash back. Some people, if they're self-employed or if they wait until the year end to do their tax return, they get it as a reduction against the tax that they will have paid or have to have paid. It's the same difference ultimately.
That's it in terms of the questions. So thanks everybody for attending this evening, and I'll hand you over just to Nick to wrap things up.